All right, so what we're going to do today is we're going to take the Costco model that we completed last week, and in the Costco folder on Canvas, I posted 3 new files. The file here is called valuation model Costco-final. That's the final one that we completed on the video last week. So you're either welcome to use that file or you're welcome to use your own file as long as you got to where we ended up on this homework assignment. I also put in the buy and the sell versions of that file for Costco. All right. But what today's going to be all about is I picked the company Blackberry, and unfortunately, based on what I saw in the 2 previous sections of this class, Blackberry is extraordinarily difficult to value just because they're doing so poorly. But it'll be a good process check for how to put the data into this model to value another company. In this case, we're going to value Blackberry. Where we're going with this is on Wednesday's class, we're going to pick another company, and then you're going to practice doing this all by yourself in class on Wednesday, the process we're about to go through with Blackberry. And then you'll have your final graded homework of the semester on Wednesday, where I'll give you yet another company, and individually you will have to value that company and turn that in as your final homework assignment. Okay? Now, any other homework assignments that are beyond that would be considered extra credit. Okay, so there will be some extra credit, but like I said, the final of the original graded homeworks will be this Wednesday, which will be due the following Monday. Okay, so that's really what we're going to focus on this week. So again, what I'd recommend is downloading this file if you haven't already, called Valuation Model Costco Final. And as I said, we're going to put the data into this file from the Costco spreadsheet. So again, if I go to that file, then in this file, I also made one more adjustment that I wanted to make you aware of, which is I took the ROIC chart and I made the ROIC chart more periods. So originally it was just the historical 5 years. I also added the forecast 11 years. All right, so now there's 16 years of ROIC in this chart. So this is something in the version that I posted for the final that you will need to either add to your own version, or as I said, you're welcome to use my version. This is going to be very important to our valuation because this ROIC chart will be a sanity check against our valuations, because it's hard to predict whether or not we're right, but we have a few things that we tend to know will tend to occur over time. And one of those is that ROICs tend to regress to the mean over the long run. That's just a bias that we should all have. And so if we look at the Costco valuation of approximately $120 a share, one of the things that we quickly see is that we were actually forecasting for Costco's stock price to be 120, but it also meant that their ROIC, which last year was in the mid to upper teens, has to grow to the low 20s in order to justify the share price that we were predicting for Costco. So when I start thinking about buy, sell, hold, this also tells me that Costco is less likely to be a buy, because as I think about the ROICs, in order to justify even their current stock price, the ROIC has to get better and better and better even in the out years, which is not likely. Because think back to our EIC analysis. This says that either the industry is getting a whole lot better and or their competitive advantage is continuing to increase over time. And those two scenarios seem to be harder to justify for a more commoditized retail industry into a long-term future. So again, this is a chart that tells me that the buy valuation is less likely, and I'm probably more likely to be at sell or hold. All right. So that's one of the things you're going to have to do for your group projects. So as part of your group presentations, you're going to have to defend this ROIC chart. So in addition to your valuations, you're going to have to pull up this ROIC chart. You're going to have to show me the ROIC chart, and it's going to have to be defensible. And right now, I wouldn't say that in our Costco valuation that this is a defensible chart. Not saying it can't happen, but it's unlikely to happen for Costco, which means 122 a share to me seems rich. All right, and so that's why I said I'm probably going to be more in the hold sell category once I throw in this ROIC chart. And what I'd like to see is I'd like to see my ROIC tend to regressing at least towards the mean. It doesn't to be the mean, but I don't like to see it going straight out into the out years. That's what's often called a hockey chart, and hockey stick charts. Usually, when you just see the straight up line into the out years, tend to be overvaluing companies over the long run. So this is just something that's unlikely to occur for most companies. All right. So again, I want to talk about Blackberry today. So using this model, I'm just going to save it and put it on my desktop. Desktop. Just put my downloads folder. All right, because I don't want to overwrite the master one that I had created. Okay, so here's what we're going to do first. We're going to go into Bloomberg. I'll log into Bloomberg. And we're going to get the data that we need to update the model for Blackberry. So in this case, I'll go to Blackberry, which they're a Canadian company. So BB space CN for Canada space equity. And there's going to be 3 screenshots that I said we will need to value a company like Blackberry. The first one is DES, which is the description, because this is going to give us the current shares outstanding. So I need to take a screenshot of this file. So what I'm going to do is I'm going to come up here, save screen as file, and in my downloads folder on my computer, BB-DES. All right, again, my convention, ticker symbol hyphen screenshot. Okay. Do the same thing with the weighted average cost of capital, because this is going to be the WACC estimate that we're going to use to discount our cash flows. So again, export, save screen as file, BB-WACC. And the third screenshot that we're going to need is the earnings estimate overview. This has the forward estimates for sales and operating profit. Again, it defaults to the quarterly view when I come to the screen. I need to switch this to an annualized view. Okay, so this is the annualized forecast for Blackberry. Consensus estimates, file, save screen as file, BB-EEO. Okay, so those are going to be the first 3 screenshots that we need for Blackberry. Right. Next, I'm going to go to the FA screen of Bloomberg, which is the financial analysis. This is where I get historical financials. In this case, historical income statements, historical balance sheets, historical statements of cash flow. So I'll go to the IS tab. And remember, we want the standardized income statement. Then what I'll do is I'll output this to Excel. So click on Output, Excel. And then Bloomberg will download this and dump this to Excel. Now it's going to give me the security warning. Am I sure I want to open this? Yes. And then it's going to dump the data into Excel. Now, if you're doing this and your file on your Bloomberg terminal says pound name and it doesn't actually give you numbers, that means that you're at an incorrectly configured Bloomberg terminal, right? Because in order for the add-in to work with Bloomberg, the add-in has to be properly installed to pull the data from the Bloomberg database. If for some reason, and there are terminals in this room that I've heard in earlier classes, give you errors on the export, go to a different terminal. Okay. Now, again, for purposes of today, I'll post these files to Blackboard or to a Canvas, but for the future, you will need to work at a different terminal that can get you this data, right? Or we'll try and get them fixed, right? So next, I need to select all the data in the tab, copy it, paste special values. Okay, so I wanted to turn these into numbers versus database lookups. Finally, Control F, I want to get rid of my pound NAs, So search for the pound n/a space n/a. Replace all of those with zeros. And then I'm going to save this file. File, save as, make sure I save it as an Excel workbook. In this case, I'm going to save it as Blackberry-income statement, BB-IS. All right, I'm going to go back to the Bloomberg terminal, and I'm going to go to the balance sheet. Again, output to Excel. Go back to my Excel, hit yes to the security warning. Wait for the data to finish downloading. Copy. Paste special values. Again, Control F. Found all my pound n/a space n/a's. Replace them all with zeros. File, save as an Excel workbook. In the downloads folder, Blackberry-BS for the balance sheet. And then the final tab that I need to export is the CF for cash flow. Again, standardized. Output to Excel. Make sure that I go back and say yes to the security warning. Once I finish my output to Excel, select all the cash flow, copy, paste special values. Final step, Control F, pound n/a space n/a. Find those, replace those with zeros. And again, now that these are all numbers, file, save as, Excel workbook, BB-CF. All right. So close out of these and jump back over to the Apple side. So if I go back to my downloads folder, I now have these three income statement, balance sheet, and cash flow data files, and I have these three Bloomberg screenshots, and I have the Costco final valuation model. So I'm going to go back to the Costco final valuation model, and I'm going to file, save this as cost valuation model BB for Blackberry, okay, because I'm now going to value Blackberry, not Costco. Then I'm going to start overwriting some data. So the first data that I'm going to overwrite is I'm going to go here to the first tab in the now Blackberry model, and I'm going to go to the Data IS tab. So right now this has the Costco data in it, and I want to overwrite with the Blackberry data that I just exported from Bloomberg. So I'm going to go to my screen with the Blackberry income statement data. I'm going to select all of this. I'm going to copy this. I'm going to now go to my new Blackberry model, select the same tab, the income statement tab, paste special values. So I'm just overwriting all the data in this tab with the Blackberry data. Now notice I'm paste special values because I just want to overwrite the data. If I paste, copy paste, I'm going to put references to that other spreadsheet. It's going to break my model because it's always going to mean that I'll have a direct link to that other spreadsheet. And every time I open the spreadsheet, it'll say, where's that file? And it's going to cause me all sorts of chaos. So I don't want to do that. So copy, paste special values. Okay. Next, I got to do the same thing with the balance sheet tab. So there's the balance sheet of my new Blackberry model. Here is the Blackberry balance sheet data I just downloaded. Select the whole tab, copy, come into my model, select the tab, paste special values. and then finally with the cash flow tab. So go to Blackberry cash flow, select the tab, copy it, come to my model, select the tab, copy, paste special values. Right? So I've just basically put in the income statement data, the balance sheet data, and the cash flow data for Blackberry. Okay. Next, I'm going to go to my assumptions tab. And here's where I need to update the data for my assumptions. First, I want to check my last reported year. If I look back at my balance sheet, I'll see that Blackberry's last reported year for the data that I just imported is fiscal 2013. They just reported it. So basically, I don't have to change on my assumptions the last reported year. Same as Costco. 2013 was the last historical year. Operating cash, we're going to leave that at 2% of sales as a starting assumption, 1/50th of the year. WACC, we have a new WACC. So again, from the screenshot that I just took, the WACC for Blackberry, 14.8%. They're an all-equity firm with no debt. So change this to 14.8%. The continuing value assumptions, that's the year 11 numbers in the model. So I'm not going to change those to start with. I'm going to leave those same year 11 model numbers alone. Price to book multiple of long-term investments, I'm going to leave at 1 for now. Shares outstanding, I had to put in their shares outstanding. So again, I go back to my screenshots, look at my DES screenshot that I just downloaded. This has the shares outstanding. Shares out, 524.2 million. So I put in 524.2. By the way, I had uploaded from a previous class in the Blackberry folder that I added to our file section on Canvas. There's the 3 file spreadsheets that I downloaded and the 3 screenshots. So if you don't have the ability to quickly do this, you can see what they are. And this is your roadmap for the screenshots you'll need to do for your upcoming assignments, including your group project. Okay, that's the data you'll need. Those are the screenshots you'll need as a starting point. Okay. All right, so back to our assumptions tab. We got the shares outstanding. Continuing value economic profit is forecast by the model. Now I need forward year sales and operating profit numbers. I get that off my EEO screen. So I go to the Blackberry EEO. These are the earnings estimates for Blackberry. I have my 2000 forward year 1, 2014, 2015. So sales, 7911. In forward year 1, forward year 2, 5206. So you can see that Blackberry is expected to continue shrinking over the next 2 years based on current consensus data. Next, we have operating profit. Operating profit, well, last year it was negative 900 million. Next year, negative 1.59 billion, so negative 1590. That's pretty ugly. And the year after that, negative 805.3. So let's call that negative 805. All right. So, shrinking and losing lots of money, right? It's not going to help with the valuation. Now, we didn't talk about this before because I'd already set this up for Costco, but there are 2 items under the reference items, is what they're called in Bloomberg, reference items section, that we'll need for our valuation model that we will get from the balance sheet tab that aren't in the standardized area of the balance sheet. So I'll make this a little bit smaller so it's easier to see. So the idea here is that when Bloomberg gives us a standardized balance sheet, here's the assets, here's the liabilities and equity, and at the bottom of the page of what you export is something called reference items. Reference items are basically items that are coming from the footnotes. So when Bloomberg is getting data out of the 10K and the 10Q, They actually have somebody who's combing through the footnotes and putting in some key items that are from the footnotes. They put them in the reference item section. Challenge with reference items, though, is that they're not the same for company by company. So the reference items change across companies. And they end up in different rows. Okay? So unfortunately, they're non-standard. Well, that's a problem for our model. To make it reusable, the model says that total equity, for example, always has to be on row 42. But unfortunately, goodwill is not always on row 66. It moves around, right? And sometimes it's not even on this list. So what I did on the Assumptions tab is I took two items that we're going to use in our model for the reference items. And if we put more in here, we can add them to this list. And these two reference items are goodwill and pension obligations. And I have to, because they're not in the same place, I have to manually move the data to this reference items rows. So here's what I'm going to do. For my goodwill, I'm going to go to the Blackberry goodwill, row 66. Now I've set it up so that the most recent year is on the left, so it's easy to copy and paste. I'm going to take the goodwill for Blackberry as a reference item, copy it after I select it across, go to my Assumptions tab, paste special values. Okay. So basically what I've just done is I've just put in the historical goodwill for Blackberry. I would do the same thing with pension obligations, except what you'll notice is that pension obligations are not listed as a reference item for Blackberry. As a Canadian company, they don't have pension obligations. So therefore, Bloomberg didn't even list them. So that's what I mean. It's not always there as an even line item for me to copy. If it is, I would put that in. I'd copy in the pension obligation data. For Blackberry, they don't have any, so I can treat that as a 0. So then I just want to make sure in my Assumptions tab that all these historical years are 0. Now, you'll notice that our model only cares in yellow about the first 6 years of historical data. Anything after that, it's ignoring. There's 10 years of data in the balance sheet tab. So if I want to make my life easier, I could just clear the contents of these extra 4 years so I don't have any miscellaneous data over there wondering why it's out there. Okay, so I can just wipe that out because all I cared about is the first 6 years. But now I've just updated my model for that 6 historical years. Okay, all right. My final step to make it a reusable model is I got to go to the Ratios tab. That's the other tab that had yellow cells. And I have to take assumptions that I had previously changed for Costco and I have to reset them. So what I mean by this is starting in 2016, for example, for revenue growth rate, we had put in a hard-coded number, 8%. So when I'm reusing this model, that hard-coded number is still in there, still has 8%. So usually what will happen is when you start putting the data in the model, and you're like, I'm getting this really weird share price, probably because you're using the data from the previous company. So you have to kind of undo the changes that you've done. So in this case, what we're going to do in 2016 is just equal the previous year, equal 2015, copy that, and paste that forward. Now you might say, why did I do 2016 and not 2014, 2015? And the answer is because these 2 years we had solved for based on the earnings estimates. So I still want to do that process. And I just updated the earnings estimates. So that gives me a proper revenue growth rate for my model, which is pretty sad that they're shrinking at about 30% and 35% for the next 2 years. But again, equals the previous year. I need to do the same thing for my cost of revenue. Remember, we made the adjustments to match. And by the way, remember here, you'll see that we have these 80% ranges, which were hard-coded in. So again, I want to undo that. So equals previous year, copy, and paste. Now I've gone to a positive share price, at least from a negative share price. I'm getting more realistic here. And then finally, I got to make sure I didn't do anything crazy with my tax rate. Now, with the tax rate, when we did Costco, we said, you know what? We'll use an average of the last 6 years for the tax rate. But when I look at Blackberry, the tax rate was 28.5, 32, 25, 26.6, 22.9, 48.5. With Blackberry, There actually is an outlier. The 48.5 looks like an outlier. And I know that Canada doesn't make its companies pay 48% taxes, right? By the way, I can also see here that they had a negative operating margin and they lost money. So that probably had some impacts on their tax rates in 2013 that may not be reflective of the true tax rate the company's going to pay on a go-forward basis. So what I'm going to do here is I'm going to take an average, but I'm just going to average the first 5 years. So instead of B9 to G9, I'm going to do B9 to F9. So that's a 27% tax rate, which I think is probably more realistic for BlackBerry's tax rate going forward than the 35% caused by that 1 year outlier going to 48. Okay? All right. This is what we had called the baseline. We're now ready to try and get close to their current share price, trying to do the as-is valuation. So file, save as, dash baseline. Now you don't have to save the baseline file, but the idea is that this is my starting point where I'm now ready to do the as-is. And right now, BlackBerry's current share price is around $6.50 a share. Okay, so what I really want to do is I want to kind of come in here and get close to $6.50 a share. Well, what do I need to do to change that? Well, one of the things, go back to the Excel model here, is I can look at their revenue growth rate. Right, so we've pretty much said we're going to do revenue growth rate and operating income, which is cost of revenue. And then I can look at cost of revenue. Now, final step that I did skip, so thanks for reminding myself of this, is I need to match the consensus operating profit with the model operating profit. Right? So right now, the model is showing an 8% negative operating margin, but the consensus, based on the forward data we just put in, is negative 20. It's getting really ugly for BlackBerry next year. Okay? So basically, I have to reduce my cost of revenue by a negative 11.97%, which means add in 11.97 percentage points. So go to the ratios tab, take their cost of revenue, plus 0.1197. And then I have to reduce it by 0.0463. So year 2 minus 0.0463. And now I'm matching the consensus. So as I said, this is actually the baseline. So I'm at about $11.87 a share. And I have to get to $6.50. All right, question.
What was the formula
For which 2015? All I did was I just added in that, I subtracted that 0.0463 just to match my consensus here. Okay. So as I said, now I'm at about 11.87. I got to get to 6.50. Now, here's the thing. First, I'm going to look at my revenue growth rate, and I'm going to say that shrinking by a third every year for the next 10 years probably is not realistic. I think at some point they're going to probably start stabilizing their market share. So what happens if starting in 2016 they stop shrinking? Right? Because the smartphone market is still growing pretty rapidly around the world. I was reading an article recently where Apple, as Tim Cook, the CEO of Apple, made a comment. He said that basically only about half of the world has smartphones that probably could. So they're saying it's about 50% penetration right now versus the amount of people they think will eventually have smartphones. There's still a lot of room to grow over the next few years. So I don't think that they're going to keep shrinking by 30%. Their shrinking is their loss of market share. At some point, this is probably going to stabilize. So what if I put it 0? They just, starting in 2016, they just stop shrinking. They just stabilize around $5 billion in revenue. Right? Now, by the way, if I look historically, just put this into context. In 2011, actual revenue for Costco, for BlackBerry was almost $20 billion. 2012, $18.4 billion. 2013, $11 billion. That's historical. Next year, 7.9. Year after that, 5.2. So stabilizing at 5.2 is stabilizing at about 1/4 of the growth they did 4 years previous. So, one, it's very sad for that company that that's how fast that they have fallen. But as I said, unless I predict they're going away, which is possible, that they stop selling BlackBerry phones, I'm going to stabilize this as a point. But here's what's interesting. When I went to zero, notice that the share price fell to $5 a share. When I was shrinking at 32%, I was almost $12 a share. When I stop shrinking, my stock price goes to $4.93 a share. Why would that happen? Why would their value actually get worse if they stop shrinking? Yeah.
Because they have a negative operating income, so just losing value for the shareholder.
Yeah, it's not just negative operating income, it's negative spread.
Yeah.
They have a negative spread. If you go back to the key value drivers, when you grow a negative spread, you destroy value at a faster rate. That's the story of BlackBerry right now. So by slowing the decline in revenue growth, then they're actually destroying more value than if they shrink faster. So that's why the stock price is going down. So the lessons of the key value drivers are playing out right here. All right. But here's what's interesting. Even if I go to zero growth, I want you to look at the valuation tab. And when I look at the valuation tab for Costco, BlackBerry, get my companies right here, then I know that I still have a couple of problems. And one of the problems is that their operating value is negative. Basically says their handset business is worthless. Matter of fact, it has a negative $3.2 billion value. So if you figure out where is their equity value coming from, it's primarily coming from the fact that they have some miscellaneous assets that are worth something, but it's primarily coming from excess cash. That basically they got 500 million shares and $2.5 billion worth of cash, that this value is just saying it would be a cash value. So if Costco just had zero sales and the same margins that they're forecast to have in 2 years, then all of the value of the business is the cash and none of the value of the business is selling BlackBerry. Now, obviously they're going to cut costs. They just fired their CEO. The new CEO is probably going to come in here and start slashing costs. But you have to think about what's happening in this poor company. That in 2004, 2005, they had close to 70% of the worldwide market share for smartphones. Now they're under 2%. Okay, so their market share has completely deteriorated. They're slashing and burning their employees and their workforce, which means, and they're slashing and burning their spending in order to get back to a profit level that is positive on the operating profit side. They're competing with Samsung, who's spending $4 billion a year on marketing. They're competing with Apple, who's spending multi-billion dollars a year in marketing. They're competing with Microsoft, who's spending multi-billion dollars a year in marketing. And they can't spend anything. They got to slash. Matter of fact, they're talking about abandoning retail sales. Part of the reason why they're saying abandoning retail sales is because to sell to customers, you got to do marketing. You got to have a sales force. You got to do channels. So that's where they're cutting back, right, in order to survive. So the reason I say this is that if I'm looking at buying BlackBerry when the board put themselves up for sale, the reason why they didn't get any bids is right here on this page, is that they have no value in their operations. Their value is in their cash, and their value is in their intellectual property, the patents that they have. Now, we don't know what the value of these patents are. It's on a cash flow basis without looking beyond this model and trying to assess those. But it's interesting that there was an article in Reuters that came out at the end of last week. And what it basically said is that the BlackBerry board actually did get some offers for the company, except they were to break up the company. Right? And it goes on to say there was one company that actually bid for all of BlackBerry, and that was Lenovo. But the Canadian government said no. They said, we're not going to let China take all the intellectual property of BlackBerry and use it in China. So they were going to sell it to Lenovo, but the Canadian government wouldn't let them. They were the only company. But I'm telling you, even if I'm Lenovo and I'm looking at BlackBerry, I'm looking at it as Google did to Motorola a couple of years ago. I'm looking at them not for their handset value. I'm looking at them at their patent value, right? The other rumored bids included Apple and Microsoft. And basically, the rumors were all they did is Apple and Microsoft said, we want the intellectual property. You can keep the handset business, right? Now, again, let's go back to this. It makes sense from Apple and Microsoft's perspective to say, look, this handset business is worthless. Even when we start to improve it, it's going to be hard to get that to a positive value given their current situation. So all of their value is in their cash on hand and intellectual property. Put yourself in the board's shoes. If you sell the intellectual property and you keep a handset business that has negative $3 billion worth of value, you've basically killed your company. Right? So that's why the board probably rejected that, because what the board basically said is the company's committing suicide by selling its intellectual property, because the only thing of value that BlackBerry has is the cash on hand and the intellectual property. That's the $6.50 a share. I'm telling you, $5 a share of the $6.50 is cash on hand. So really, if you think about it today, that's what I said, this is a far more difficult valuation to do. BlackBerry is not being valued based on its cash flows. BlackBerry is being valued on its breakup value. $6.50 a share is getting close to its breakup value. All right, it's a floor. And the floor is the cash on hand plus the intellectual property value, minus any debt that they have. Now, they don't have any pure debt, but they do have some accounts payable. And right now on their balance sheet, if I looked at the liabilities that have to be paid, what I'm saying is the breakup value, cash minus payables plus intellectual property, works out to $6.50 a share. Right? That's where I think the market is working towards BlackBerry's value. So when their hedge fund offered $9.30 a share or whatever it was a couple months ago, that's why nobody would finance it. Because I'm telling you, if you're a banker and you're thinking about financing an equity transaction, whether you're Goldman Sachs or whether you're Chase or Citi, and you're looking at the same data that we're looking at, you're basically saying, look, all I'm doing is I'm financing the assets and breakup value. As a bank, they're not going to generate the cash flow to pay off the loan. That's why they couldn't get the loans. No rational banker in their right mind would lend money to fund a takeout of this company to go LBO, given the same data that we are looking at, because it's saying they have a negative value and they are burning through cash to run their business, that their EBITDA actually goes negative. So why would I want to finance that? I have no path to get my money back unless I go seize the assets and try and sell them on the marketplace. Banks don't lend that way, right? And even the private equity firms didn't want to do this. So it was back to strategic acquisitions, people that wanted their portfolio for patents, they bid on the patents. But then the company said, I'm not going to sell you my patents because my company basically goes away if I sell you my patents, because then there's no value left to fund a handset business that's worthless. So that's what I said. This company becomes too hard to actually value, because what it really boils down to is putting a number on their patent portfolio. And that involves beyond our model. Because with Costco, we could value the cash flows because they were actually generating value from their business. And if Costco had any IP, the IP would lead to those future cash flows. BlackBerry, they're going to negative cash flows. So BlackBerry is more of valuing them as a breakup. Because, and let's think about this, what's it going to take on the operating basis to get their share price to $6.50 a share? Well, we know from revenue that increasing revenue is only going to decrease their value because they have a negative spread. They have to turn their spread positive. And in order to turn their spread positive, they're going to have to reduce their cost. So if these are the assumptions for costs for the next 2 years, then I could start going 3 years out and say, instead of 59, let's call it 55, which means that's probably close, 654 a share. that they need to get their operating income, and well, that's going to be negative because they have all this depreciation for assets they bought that they can't use. They need to get their EBITDA margin to about 6%, down from, it used to be in the high 20s or 30s, but down from losing money to about 6%. So that's really the point, is that it's no longer about even their operating margin for BlackBerry. It's really about their EBITDA. It's about their gross cash flow. And they need their EBITDA to basically go to around 6%. And unfortunately, they're not anywhere close to that right now. So that's where I said the big challenge with valuing BlackBerry. All right, so we're not going to finish because it's too speculative. But as I said, process-wise, I've at least recorded this because on Wednesday, I'm going to give you an easier company to value and a little bit more straightforward, and you will go through a similar process and then try and come up with a value for them. Questions about any of this? While you're asking questions, I have to plug my battery in because my battery's down to 5%, and this video is going to die in the middle of recording. So, questions?
So when you're talking about like the art of like the valuations from certain numbers, does it just come from experience, or is there like certain like procedures you have in place?
Yeah, I think that the short answer is that the art of valuation does help to have experience. But even without experience, like what I would start to do is I'd start to look at other data. So for example, even in Bloomberg, and for power saving reasons, starting to shut down my all my data here because my battery's about to die. So if I can see if I can go back to Bloomberg. All right, so let's say I'm back in Bloomberg. I go to the RV section of Bloomberg, and one of the things I could do is I could look at some of the BlackBerry peers. So what I'll do is I'll come here to, for example, when we were looking at the metrics before, I can kind of get a sense of what is, for example, an operating margin of the peer group. So I have a sense of what is reasonable and achievable of the industry. Matter of fact, if I add a column to this, I could look at my Ebitda margin. Okay, so this Ebitda to revenue. There it is. So there's my Ebitda margin. Put this over here before the operating profit margin. And I can see that, at least based on historical data, you know, where is this industry? And you can see Motorola, which was doing horribly. But basically, this was before Google bought them. But, you know, take out Motorola, take out BlackBerry, the rest of the industry. Samsung's at 20%, Apple's at 33%. You know, Nokia is losing money. So that's the problem, is you have basically the haves and the have-nots. If you have the devices that people want, you actually do really well. If you don't, right now you can't make any money. And that's the problem, is Nokia and BlackBerry are in the can't make money camp. And then you have the HTC is like the hanger on. But HTC, that's the problem, is nobody wants their phones either. And their gross margin is plummeting because they're having to give the phones away and you have to spend too much to get the phones sold. Yeah. Oh, question. Okay. All right. So let's go back to finish up. Two parts of the analysis that we will need to do for our company is, as part of your group projects, to help you do the valuation. The other thing you want to do is you want to look at the past to help you understand the future. And one of the sections of your group project is to do a historical CFI analysis and a historical ROIC tree. So the BlackBerry ROIC tree is going to be too hard to do, just because they're losing so much money. We can come back and look at it in just a second. So what I'm going to do is I'm going to open up the Costco model. the Costco final model. And I'm going to go to the ROIC drivers tab. And this is the ROIC tree already filled out based on historical data for, in this case, Costco. So now we're switching away from Blackberry. I'm going back to Costco. As part of your group project and your homework assignments coming up, you're going to have to explain the changes in 5-year ROIC based on EOI or end of year ROIC data. So 5 years ago, Costco's ROIC was 11.6%. And 5 years later, Costco's ROIC was 16.4%. So basically, their ROIC improved over a 5-year period of time. This percentage under the table numbers is the 5-year percentage change. Over a 5-year period of time, their ROIC went up by 42%. So what we want to do is we want to explain, why did the ROIC change over 5 years? 3 factors. Always 3 factors that explain ROIC. Tax rate, operating margin, productivity, invested capital over sales. Those 3 numbers always explain the change in ROIC for the company. So let's start out with the tax rate. 5 years ago, Costco's tax rate was 36.6%. Last year, 32.4%. An 11% decline in their tax rate. That should have helped their ROIC, which is one of the reasons why their ROIC went up. Question is, was that the only reason their ROIC went up? Well, if we look at the pre-tax ROIC, it went from 18.3 to 24.3, a 33% pre-tax increase. So some of the ROIC improvement was because of a lower tax rate, but they did improve the operating performance of their business internally. So pre-tax ROIC is margin times invested capital over sales. It's actually 1 over invested capital over sales. 1 over this is that. So margin times productivity equals ROIC. Margin went from 2.5 cents to 2.9 cents. An increase in their operating margin of 15.6%. That helped their ROIC. Productivity went from, to generate $1 of revenue, they had to spend 13.8 cents on invested capital. To generate the same $1 of revenue, they had to spend 11.9 cents on invested capital. Their invested capital to sales went down by 13%, which means they also improved their productivity. So really, for Costco, their ROIC going up was a function of all 3 factors. It was the factor of their tax rate going down by 11%. It was the fact that their operating margin went up by almost 16%. And it was factored by their productivity, meant they made 13% less investment to make the same sales. Their productivity went up. Combination of all 3. That's our first level of analysis. And all 3 of them had fairly similar impacts based on the percentage change. Second level of analysis. Why did the operating margin go up? 3 factors off the income statement affect operating margin. Gross margin minus SG&A minus depreciation equals operating margin. So these 3 factors define the operating margin. If we look at Costco, gross margin 13.7 to 13.5. Their gross margin actually was relatively flat, went down a little bit, went down 2%. That did not help their operating margin. SG&A went from 10.2 to 9.7. Their SG&A went down faster than their gross margin. That helped their operating margin. Depreciation, virtually unchanged. Right now, there's some rounding here, but it's a tiny number, 0.01 to 0.009. So really, at Costco, it was all about the decline in SG&A as a percentage of sales. That led to the operating margin. On the balance sheet, invested capital over sales is this plus this plus this. It's working capital plus PP&E plus intangibles. If we look at Costco, they pretty much didn't have any acquisitions 5 years ago. They don't really have any acquisitions today. Virtually no intangibles. So for Costco, it's working capital and PP&E. Working capital went from negative 1.6 cents to negative 1.3 cents. They actually have, even though it's negative, They have slightly less negative working capital, which meant that should have hurt their productivity. So at Costco, all of this productivity gain came from PP&E over sales. 15 cents to 13 cents, a 13.5% decline in PP&E. So why did Costco's ROIC improve over the 5 years? Primarily because they benefited by a lower tax rate and because their SG&As went down and their PP&E to sales went down as the two primary factors of the ROIC improving over 5 years. That's the insight that we have to be able to explain, just as I did with the ROIC tree for any company. Those are the factors that will always apply to any company, right? And this gives us an insight. So the exact opposite happened at Blackberry. So let's go back to Blackberry. And let's look at their ROIC tree. So this is their ROIC tree. So their ROIC was 63%, went to negative 13%. Big drop in ROIC, 120% drop, negative 120% drop. So that these numbers almost become meaningless. It's just ugly. So they got hurt by taxes. Well, they got other problems, but they're paying more in taxes. That didn't help them. Pre-tax ROIC went from negative 94 to negative 25. Why? Operating margin went from 25%, which is about where Samsung, Apple are today, right? And it fell to negative 8 cents. Right? They're losing money on an operating basis. And invested capital to sales went from 26 to 33. So they spent money to grow and they ended up losing money. This is the loss of competitive advantage right here. By the way, what happened to their income statement? Interestingly, the gross margins on their handsets are virtually unchanged, 49 to 48.3, a slight reduction. Given this collapse of operating margin, I would have expected this to go down more. It's not. What's their real problem is the SG&A. They're spending a huge amount in SG&A. It went from 21.5 cents to 39 cents. And depreciation went from 3 cents to 17 cents. Now this is non-cash, but this SG&A really hurt them on a cash flow basis, which is why they had the negative operating margin. Working capital actually went down slightly, which should have benefited their productivity. PP&E to sales went up dramatically, and they didn't really do any acquisitions, so it was all PP&E to sales. That's also why the depreciation rate went up. Now here's why. We can see this visually. On their balance sheet, their PP&E, which is net fixed assets, was going up. It went from 1.3 to 1.9 to 2.5 to 2.7. Now last year they were at 2.4. But here's the challenge. As revenue was growing, it made sense to invest in all those facilities, right? But then the problem is that starting in 2012, they started to shrink dramatically. They went from 18 billion in sales to 11 billion in sales. So basically, they spent all this money to sell a lot of volume. They expected to sell a lot of handsets. The problem is the sales didn't materialize, and then they lost about 1/3 of their sales. So the fixed assets don't really change, nature of fixed assets. Sales went down dramatically. It killed their productivity. Same thing. Look at their operating expenses. Operating expenses went from 2 billion to 4.7 billion. Last year they spent 4.3 billion, but sales went down by 7 billion. They spent the money as if the sales were going to grow, and the growth didn't occur. So that's why they're really in trouble, is because their operating expenses are way too high relative to their sales. But the problem is, if their sales drop another 3 or 4 billion, and then another couple billion after that, they're going to have to dramatically cut their operating expenses in order to return to profitability. And what I'm telling you is Samsung spent $4 billion on just advertising and marketing alone, mostly in the US. So if you think about Blackberry, that's why I think that they're on the death watch right now, because they just can't afford to not spend and sell. They can't afford, what's Google on KitKat? Google and Microsoft are on cycles, Google and Apple are on cycles to release their new operating systems. at a rate of once a year or faster at Google. Google's doing it about every 9 months. Apple's doing it about 12 months. How do you keep up when you can't afford to spend money on development? How do you keep up when you can't afford to spend money on ads? That's going to be their challenge, is that as they slash all their spending, then they're not going to have the ability to innovate and to try and go into this growing market. That's why I put them on death watch and say they're not going to survive. But again, here's the final analysis we have to do. And again, I'll go back to Costco. We have to do a CFI analysis. So under CFI, we have to do a 5-year historical CFI. Now what that means is columns H through R are the forecast years. So what I'm going to do is I'm going to hide, don't delete, hide these columns. And what this will now give me is 5 years of historical CFI. And the totals sum up the 5 years. So part of what you're going to have to do for your group projects and other assignments is you're going to have to explain the historical CFI. Now again, the historical ROIC tree, the historical CFI, will help us as we do our evaluations. So the question that came up a few minutes ago is, how do we know how to make these changes? Part of it is we understand the past, right? So what happened with Costco? Well, they got about $12.2 billion of gross cash flow over 5 years, consistently increasing year over year. Gross investment was about $7.5 billion. So they reinvested about 61.5%, giving them about $4.7 billion of free cash flow after reinvestment, or about 38.5% to pay out. They pretty much didn't do any acquisitions, so all that became free cash flow to pay out. Okay? Now, for Costco, they really didn't make a lot of non-operating investments. As a matter of fact, their CFI went to $3.5 billion, mainly because they increased their cash holdings. They put more money into their savings account. Okay, so what did they do with the $3.5 billion that they did give to the investors? Well, one of the things they did is they increased their debt by $2.9 billion, which we clearly know they didn't need to do. And a lot of the reason why is because they paid out $5 billion worth of dividends, including a special dividend in 2013. And they bought back $1.9 billion worth of stock. So they took all their cash flow, plus they increased their debt, probably take advantage of low interest rates, and they use that to pay out essentially a big dividend. So they changed their capital structure. All right, let's look at Blackberry, CFI. What's going on with them? Again, I want to take columns H through R, and I want to hide them, not delete. And let's look at their historical data. Well, their gross cash flow was $14 billion. The difference, though, is it's trending downward. It peaked at $4.3 billion in 2011, then 2.95, then 1.45. So basically, they are seeing a decline in their gross cash flow in the last couple of years, but they still achieved a lot of gross cash flow over a 5-year period of time. Gross investment of $7.7 billion, 55% rate. But again, you see that their gross investment peaked in 2012, and they started to slash it dramatically in 2013, probably anticipating the challenges with future sales and revenue. Okay? Giving them a reinvestment rate of about 55%. Again, not a lot of acquisitions, about 46% to pay out after acquisitions. Now, they also made a big investment, particularly in 2012, into some non-operating assets. Right? Don't know what they are, but that chewed up almost $2.3 billion worth of cash. So unlike Costco, which took most of their cash and put it in the savings account, Blackberry made some non-operating investments. They probably bought their way into stakes in other companies, would be my guess, but we'd have to validate by reading the 10Ks. Okay? Giving them $2.7 billion to pay out. Interestingly, they repurchased $3 billion worth of shares, almost all of which occurred 3 and 4 years ago. Virtually no repurchases in the last 2 years. Now this is interesting because given that their stock price is falling like a rock, and given that they don't have good investment opportunities, why do you think they slowed down the cash share repurchase? Why did they stop distributing that cash to the shareholders? Yeah.
Maybe they don't think their stock is undervalued.
So yeah, their stock might actually be overvalued, so it may not be the best time to buy it back. But I also think there's another thing at work, which is they need the cash. If they give the cash out to the shareholders in the form of buybacks, no bank in their right mind is going to give them new cash. So that's the problem, is that they can't afford the stock buyback because they're actually going to need the cash to fund their negative losses and give them a cushion to operate in the next couple of years while they try and turn their business around. So they're in an interesting conundrum because they have all this cash, but the cash is destroying value. So this leads to my final prediction about BlackBerry, which is by looking at the cash flow situation, the fact that they have no operating value, the fact that they're having huge operating losses for the next 2 years, even with the expected cuts that the analysts think that they're going to make. I think the board is going to be forced to sell this company. And then even though they rejected the sales last week, it's a short-term rejection, and they will be sold within the next 3 months. That's my prediction. I could be wrong, but that's my guess. Except they're not going to be sold at $9 a share. They're going to be sold at a breakup value. And that breakup value is going to be closer to $6 a share. So at $6 a share, which is the value of the IP and the cash, I think that's the price that they're going to sell. The problem is the board is trying to get a higher price for the breakup of BlackBerry. And they're just not going to get it because the handset business is virtually worthless. So the only company that's going to buy them has to look beyond the IP and see some value in their customers where there is no cash value from the losses. So I'm telling you, when you go back to this Reuters article, it won't be the Chinese because Canada is going to block China from owning its IP. So that restricts any of the Chinese handset makers from rescuing BlackBerry. It's not going to be Nokia because Nokia just got bought by Microsoft. It's not going to be Apple because Apple only wants the IP. It's not going to be Google because they already made that mistake with Motorola. They bought a company that had the exact same problem for the IP. They overpaid for the IP, and they don't need to make handsets because nobody's really buying the Moto X phone anyways, and they don't want to compete with their ecosystem. So long story short, when you think about who's going to buy BlackBerry, the list narrows down back to Microsoft. It's going to be Microsoft. So Microsoft is the only company out there, and my guess is Steve Ballmer will be forced to do it before his replacement shows up. So that way, if they screw it up, they can blame Ballmer. But basically, it will be Microsoft. They spent $8 billion on Skype. They could spend $3 billion on BlackBerry for the intellectual property. But that was the thing. You need the board to understand that that's the price. And that's where the market is today. BlackBerry is going to start trending down into the $6 range. And they're not $9 a share anymore. And the board wants people to buy them at $9, and nobody's going to buy them at $9. So once we've established that this is the fair value of the company, then the sale is going to occur closer to this price. So I'm just telling you, BlackBerry is going to get sold, my guess, $7 or less. And it's going to happen in the next 90 days. I don't see a lot of upside. But they're being bought for the IP and the cash. And they can't lose a lot of cash in that interim. And I don't think that BlackBerry is going to be able to survive longer term without doing it. Now, there is another scenario that I think that could happen, which is they bring in a new person. That new person just gets out the axe and slashes and burns as fast as they can to try and make the numbers look better, to try and get a higher share price. But the problem is it comes down to revenue. And if they still don't sell phones, no matter how much cost you cut, nobody's going to want to touch that business. And unfortunately, I don't think there's anything they're going to do in the next 6 months that are going to let them sell more phones. And that's their problem. Because the one company that is emerging as the third viable competitor is Nokia. Nokia's actually had some success in the last 3 months with their new phones, and Nokia is Microsoft. So that's the point. You get the third operating system has now been established by the market. It's Windows Mobile. So you basically have Google, you have Microsoft, and you have Apple. There's no room for BlackBerry, and they can't afford the spending. So that's why I said they go away. And it's just a question of who buys them and how much. And anyways, those are my predictions. But this was the idea of the CFI analysis, the ROIC tree. What we're going to do in the next class, as I said, is on Wednesday, I'm just going to give you a company. In class, you're going to have to download and do all this yourself. Okay, so taking the training wheels off. And Wednesday after class, I'll give you another company, and that'll be your homework assignment for next week. That's what you'll have to do between now and Monday. Okay, so again, I'll post this video, hopefully to Google, if the audio worked.